Welcome, traders. January 5th, 2026. Opens with major geopolitical tension in Venezuela, yet Nasdaq futures are climbing 0.6%. Oil is moderating its losses, and Bitcoin whales just repurchased 10,000 coins. These next 10 minutes will break down the macro data, institutional positioning, and 10 technical scenarios for the next 12 hours across stocks, crypto, and commodities. This is critical. This is 100% educational content to help you learn technical analysis. It is not financial advice. Always do your own research and only trade with capital you can afford to lose. What's your take on the markets ignoring the situation in Venezuela? Comment below and stay for the full breakdown. Let's get into the key context. We're seeing reports of U.S. intervention in Venezuela, with Maduro reportedly detained. The market reaction has been interesting. Energy stocks like Chevron and Repsol rallied, but after an initial spike, oil prices pulled back. This makes sense when you remember that Venezuela accounts for less than 1% of the global oil supply. Meanwhile, Wall Street futures are up across the board. The Dow, S&P, and Nasdaq are all showing gains of 0.3 to 0.6%, despite this geopolitical shock. It seems the market's focus is quickly shifting to this week's U.S. ISM manufacturing and jobs data, along with inflation numbers coming out of the Eurozone. From a central bank perspective, the market is currently pricing in 2 to 3 rate cuts from the Fed in 2026, with the ECB expected to follow a similar path. So, the macro thesis right now is that markets are willing to tolerate geopolitical events as long as the broader economic data doesn't fundamentally change the outlook for growth and inflation. And don't forget about January seasonality. Historically, the S&P has seen an average return of about 1.2% this month. Now let's look at equities and institutional positioning. From a technical standpoint, the S&P 500 is showing a consolidation bias to the upside after its strong rally in 2025. The Nasdaq continues to lead, powered by ongoing strength in AI and tech sectors. Over in Europe, the Stoxx 600 is trading near its highs, with automation and industrial stocks performing particularly well. So, where is the big money positioned? It appears portfolio managers remain fully invested, taking advantage of the liquidity provided by the Fed at the end of last year. In markets like India, we're seeing foreign institutional investors increasing their net long positions. The consensus for the S&P 500's year-end target for 2026 is clustering around the 7,600 to 7,700 range, which would represent a 10 to 12% gain from here. For the intraday setup, a typical January statistical pattern we often see is a controlled pullback of about 0.3 to 0.7% down to the VWAP, or the morning's low, which often presents a point of interest for traders. Shifting gears to crypto and on-chain whale activity, Bitcoin is holding a tight range between $92,500 and $93,000. Some are calling this 2026 rally fragile, but so far it's holding firm. Looking at the on-chain data, we saw whales in the 10,000 to 100,000 Bitcoin bracket sell off about 50,000 BTC between December 29th and January 3rd. However, in just the last 24 hours, they've repurchased 10,000 of those coins, valued at around $900, and $12 million right after the breakout above 90,000. In the derivatives market, one whale on Hyperliquid is holding $32.6 million in long positions across 17 different cryptocurrencies, currently showing an unrealized profit of $3.4 million. For altcoins, Chainlink is interesting. Whale holdings have increased by nearly 58% in the last 30 days, even though the price is struggling below $12.50. For Lido, we've seen a 30% increase in whale holdings in just 7 days, and its on-balance volume is breaking its downtrend. And for low-cap flows, a token like Aster has seen a 2.37% increase in whale interest in the last 24 hours, making it a high beta candidate to watch. Okay. Let's bring it all together with 10 educational scenarios to study for the next 12 hours. Remember, these are not signals, but learning exercises. Scenario 1. The S&P 500. Watch for a first-hour pullback to the VWAP or the morning low, especially if futures maintain their risk-on sentiment. Scenario 2. Energy stocks. Look at their relative strength against WTI crude oil. This is the Venezuela spread play. Scenario 3. Gold and silver. They could act as a macro data hedge. Keep an eye on the 20-day moving average as we await jobs and ISM data. Scenario 4. Treasuries. A rally in treasuries, meaning yields decline, could happen if the ISM data comes in weaker than expected, reinforcing the Fed rate cut pricing. Scenario 5. Bitcoin. A test of the range low support around $92,000 would be interesting, given the recent 10,000 coin whale repurchases. Scenario 6. Ethereum. It often acts as a beta play on Bitcoin. Watch the key demand zone, especially in a risk-on environment for alts. Scenario 7. Chainlink. A test of the $12.50 resistance level is key, especially with that 57% accumulation by whales. Scenario 8. Lido. It's trading in a range between 49 and 59 cents. The bullish OBV and its connection to ETH staking are the key context here. Scenario 9. ASTA. This is a 24-hour flow play. It represents maximum beta, driven purely by recent whale interest. And Scenario 10. Crypto stocks. Miners and exchanges will likely follow Bitcoin's correlation. Watch their pre-market performance for clues. So, to summarize, the Venezuela shock is being absorbed, and the market's focus has shifted back to macro data. The key skill is learning to connect these geopolitical events with fund flows and the technical picture. Which of these 10 scenarios are you studying today? Let me know by dropping the number from 1 to 10 in the comments. If you learned something, please hit that like button and subscribe for our daily technical analysis throughout 2026. This content is for educational purposes only. Always do your own research. See you tomorrow.